what we're going to be going over here is cost, volume, profit analysis, where we're going to be looking at the sales here of multiple products. We're going to group these multiple products here together into bundles here, and based on those groups of those bundles here, we're going to have to determine the income here. Now, what we're going to be looking at here is the change in the sales mix here on these bundled products or these groups here, and how the change in any sales mix here can affect the income here on the products. And our example here is going to be based on some bundled products here of product A and product B. But going through this example, you could use the same procedure here if you had any number of products that you're grouping together, like A, B, C, D, and so forth. Okay, so the first thing you have to start with here when you're talking about your grouping or bundling those products together here, you have to determine the sales ratio here between the different products that you'd be selling here. And for our example, we're going to be looking at our budgeted versus our actual amounts here, and we'll start with our sales ratios here. So for our budgeted amount here, we're going to have, again, those product A, we're planning to sell 30,000 here of product A, quantity of 30,000, and for product B, quantity of 10,000. And that's going to give us a sales ratio here of 3:1, and that's simply taking the 10,000 here of B, dividing in a 30,000 here of A. That gives you 3 here for A, so and for B, 10,000 into itself is going to give you a ratio of 1. So what we're going to be doing here is we're going to be selling 3 here of product A here for every one that we sell here in product B. And then looking at our actual sales ratio, this is where it's going to change. For product A, instead of selling 30,000 that we budgeted, we're now going to be selling 36,000 here of product A. And for B, instead of the 10,000 that we budgeted, we'll be now selling 4,000 here. That's our actual sales. And based on those amounts here, we're going to have a sales ratio of 9:1. Simply the 4,000 divided into 36,000 is going to give you 9, and 4,000 into itself is 1. So for every sale, for every one that we sell here for product B, we're going to be selling 9 here for product A. And then just looking at our total sales, well, just going to be the same here for both our budgeted and actual amounts here. A, 30,000 plus 10,000 of B. For the budgeted amounts, 40,000, and then for our actual amounts, 36,000 plus 4,000 gives us 40,000. So the only thing that's going to change here in this problem is the sales mix here between our budgeted and actual amounts. Total amounts stay the same. Okay, so let's go down and let's look at these ratios here. Just break them down a little bit so you understand them. So for our budgeted sales here, again, we talked about A, 30,000. 10,000. For B, we calculated that to be a 3:1 ratio here, and that's what we're going to be using here for our example. I'll just be for when we start doing our calculations, it's going to be based on the 3:1 ratio here, 3.0 and 1.0. And in this case, each bundle includes, again, 3 of product A here and 1 of product B. So a total amount in each one of the bundles here is 4, a quantity of 4 here between A and B. So in this case, it's going to be 10,000 bundles here, because our total sales here is 40,000 in both cases here, divided by a quantity of 4 here per bundle. That's going to give us 10,000 bundles that we're going to be looking at. Okay, so that's for our budgeted sales here. Now let's go down and let's look at our actual sales here. We're going to have to do some conversion here. And again, our sales ratio, we had 36,000 here for A, 4,000 for B, 9:1 sales ratio based on those amounts. But what I want to do here is I want to convert here, because if I leave this sales ratio here of 9:1 versus on our actual sales and start comparing it to our budgeted sales here, 3:1, we're going to have a scaling factor of 3 that we have to deal with when we're looking at those bundles that are sold here. And what I want to do is bring this in. I want to bring our sales ratio here for our actual sales in line with our sales ratio here for our budgeted amounts here, and for the comparison, just to get rid of that scaling factor that you'd have to deal with. Okay, so how I would make that conversion here. Again, I know that each bundle here is going to each bundle for both the budgeted and actual sales here includes 4 units here, or quantity of 4. And how, just looking at our conversion here, we can look at it in terms of thousands or whatever dollars here. The budgeted sales, say, was, our actual sales for our product A here was 36, or let's say 36,000, and our total sales here was 40,000. So just making that division here, we're going to come up with product A here is going to be allocated 90% here of that 40,000 quantity of 40,000 sold, total of 40,000 sold for the bundle. Take that times our unit here, our quantity here for the bundle of 4 per bundle here. That's going to give us 4 times 90% is a 3.6. So that's just how I got my scaling, or converted this 9 to 1 over to basically the 3 to 1 ratio here. So for product A, with the conversion here, it's going to be 3.6 instead of 9 here for our sales ratio here. And for B, well, it's just 0.40 here. We had the total of 4 here, subtract 3.6 here, allocated to A. Essentially, B gets the 10% here, 0.40. So that's going to be the sales ratio that we're going to be working with here. So for each bundle here, for actual sales, A, we're going to say 3.6. Quantity of 3.6 is going to be allocated to product A, and 0.4 here for product B. So that gives, again, our total amount here would be a quantity of 4 per bundle. So we're bringing our budgeted amount and our actual sales in line here, and I'm just doing that. You can leave it at 9 to 1, but when you start plugging in your quantities and so forth and your contribution margins, you're going to have a scaling factor to deal with when you're making the comparison. Okay, so that's how our sales ratios have to be set up here, just so you can understand the difference here that we have here. We actually had a change here between our budgeted sales and our actual sales, and these are critical numbers here when we start looking at calculating our profits and so forth here. Okay, so next thing, let's move down here and let's look at looking at our operating income equation here in determining a break-even point. You can determine your operating income using this equation here, but the key is here, when we're dealing with these bundled products here, this quantity sold, we have to determine the proportion here between the two different products, in this case the two different products that we're looking at here, product A and product B. So just going through our income equation here, looking at product A here, and this is where we're going to be looking at the break-even point here to determine how many units we have to sell here to break even. So product A, we're going to have a selling price here of $2 per unit, a variable cost here of $1.40 per unit. So the difference here is going to give us contribution margin here per unit. Difference between selling price and variable cost is going to be 60 cents. So that's going to be a contribution margin here per unit for A. And this is the case here where we start plugging in those ratios here. And this is, we're going to be just you'd have to do this for both the budgeted and actual sales, but we'll just do it in terms of our actual sales here. So for our actual sales, product A we set that ratio, we're allocated 3.6 here, and I'm just showing it as a quantity here because we have to solve for the quantity here to determine the break-even point. So 3.6 Q here. Now product B, our selling price here is $3 per unit, variable cost $1.80. So the difference gives us a contribution margin of $1.20 per unit times, in this case, the ratio that was allocated here, product B here, was 0.4 Q here. Now then you would subtract out your fixed cost here, 12,000 from that quantity here, and when we solve, okay, our contribution margin here for product B is $1.20 times 0.4. For product A, it was 60 cents here times 3.6 Q. So netting those, adding those together here and figuring out your Q, you're going to get a total contribution margin for both product A and product B of $2.64 times Q here. Then solve for Q, 264. Move 12,000 over to the other side of the equation, you're going to come up with, dividing $2.64 into 12,000. The fixed cost here is going to give you bundles here. The break-even number of bundles is 4,545 bundles. Now, that's broken down here for product B is going to be allocated, well, 4/10 of the Q here, and for 4/10 times 45 is going to give you 1,818 quantity that you have to sell for B, and then product A gets their ratio here of 3.6, and that's times 45, that's going to give you 16,363 here for A. Now remember here, these actual sales was based on that sales ratio that we recalculated here, that 9-to-1 that I converted over to 3.6 to 0.40. Now this is the procedure here. For our regular, or for what we had budgeted, we would have been using 3 here for product A instead of 3.6, and for product B it would have been 1 here for a Q here, excuse me, for product B. Okay, so we went through it here, just looking at it in terms of our actual sales. Now we're looking at our break-even quantities here. Total amount here we have for our actual sales, adding a product B and product A together, is 18,181 total quantity. Now, had you worked it through here for the budgeted amounts, you'd putting in your scaling factors or your sales ratio for the budgeted amount, you'd have come up with 16,000 here. In the budgeted sales break-even point for budgeted would have equal 4,000 bundles here. So that's how you go about determining. You can determine your operating income that way. In this case, we just determine our break-even point. Now let's go and let's use these ratios and that, and let's look at it in terms of calculating. Let's go over here. Let's look at it in terms of calculating our incomes here, both our budgeted versus our actual, based on our budgeted versus our actual sales here. So this is the case here. Got a lot of numbers shown here, but we're going to be looking at it, and we're going to do their calculations, and we'll be laying out our calculations here on a cost, volume, profit graph. And this is the case here where we're going to have our bundles sold here in thousands, again along our x-axis here. I'm showing along our x-axis, and then along our y-axis, those are going to be our dollar amounts here for our sales, our costs, and also our fixed cost and so forth. So what we have to do here in this problem, we have to determine our revenues line here for both our budgeted and our actual sales here, and on a per unit basis. We're going to have to determine how much revenue on a per unit. When we talk about a per unit basis, this is all based on our bundles sold here. So all our conversions are based on bundles sold here. And then we have to determine our costing on a per bundle basis here. And we're going to have to do that for both, again, both our budgeted amounts here and our actual amounts, to see what changes we have here for revenues versus costs, any changes based on those sales mix here. So we're going to, our green line here is going to be our costing line, our brown line here is going to be our revenues line, and then I'm showing those solid amounts here are what our budgeted amounts would be, and then the dashed amounts is what our actual amounts is. So we're going to have to determine our break-even point here, and you'll notice here with our costing line, it intersects our y-axis here at $12,000 here. So this is the case where our cost from 0 to 12,000 represents our fixed cost. Now our sales here starts at 0 and moves on up. Okay, so let's go and let's look at how we'd make our calculations here, just to determine those per unit or per bundle dollar amounts here. Okay, so up here. Okay, this is where we're going to be calculating our revenue costs and contribution margin for each of the bundles, for each bundle here. That includes A and B. So what you want to do here, you want to lay out your costing here. What you really want to get to is those dollar amounts here per unit, per bundle here for our revenues, our costs, and also our contribution margin here. So we'll just start with our bundle here with a sales ratio of 3-to-1. That is our budgeted amount here. That was our sales ratio here, 3-to-1. And this is how you want to lay it out here. You want to take your product A here, product B, and you want to determine this. You have the selling price, your variable cost. The difference is going to give you the contribution margin that you have here for each of those products. And you want to determine the total amounts here. So let's just go through it here. So for product A, our selling price here was $2 per unit. Now this is where we put in those ratios here, the sales ratios. For A, for our budgeted amount, that was 3 here. So I'm just putting that in as 3Q here. And then for product B, selling price here is $3 per unit times a sales ratio here of 1 here, 1Q here for product B. So our total revenue here based on our selling price is what? 3 times $2 here for 6 plus 3 times 1 here for product B. So total revenue here is $9 here. So for each bundle that we sell here, our totals for each bundle of product A and product B, $9 is going to go towards our revenue here based on the bundling of product A and product B. Now, looking at our variable cost here, let's look at that. $1.40 here for A times 3Q, $1.80 here for B times 1Q. So whatever, 3 times $1.40 plus 1 times $1.80 is going to give us a total cost here of $6 per bundle, or per our product B, A and B put together. So that's our total cost that we figured out. And then contribution, you can look at it in these terms here. Difference $2 here less $1.40 is 60 cents here per a unit here for product A times 3Q, and then for product B, 3 times 3 subtracting $1.80 here for variable, or $3 selling price, $1.80 for variable cost, gives us $1.20 here in contribution margin times 1Q here. So you can see we put in those ratios here. A, we put in a ratio of 3, B, a ratio of 1. And that gives us a contribution margin here. If you do 3 times 60 cents, $1.80, 1 times $1.20, that adding those together, you're going to get $3 a contribution margin here per bundle here. So we went through the mechanics here, but you can see you can either just set your chart up this way, put in your set up your looking at your sales ratios here, plug those in, know your selling price, know your variable cost on a per unit basis here for products A and in this whatever products you're looking at, and then difference here, selling price, variable cost is going to be your contribution margin per unit here, and you can. All I'm doing is setting up in a convenient table here so you can understand how you calculated your dollars in revenue per bundle that you're selling or per grouping that you're selling, your costing here, and your contribution margin. So contribution margin, is simply the difference between selling price and variable cost, and that's simply the difference between your total amount here, revenue, less, in this case, $9 here per unit for revenue, less $6 per unit here for cost. Difference is going to give you $3 here in contribution margin. Okay, so you understand, just set it up in a neat little table like this, determine what you're after is those total amounts here per bundle here and per grouping that we're looking at. Okay, so same thing we won't go through the numbers here, but for our sales ratio for our actual amounts, go through the same procedure here, but then in this case for the actual amounts, in this case you look at the sales ratio here. For A we had a 3.6 ratio here, and for product B was a 0.4 here sales ratio. Just take your sales ratios, plug them in, and then you can determine your revenues here. And if we would go through our total revenues here, go through the arithmetic here, it would be $8.40 per unit here for total revenues here for each bundle that we sell. Cost would be $5.76, and then the difference here gives us the contribution margin here of $2.64 per unit. So you can make the comparison just looking at your charts here. Now let's go and let's put these numbers down, or put these numbers here onto our cost volume profit graph here. So for our revenues line here, that's that brown line here. Our budgeted amount, I'm showing that as the $9 here, and then the dashed line here, that is the actual sale, that was $8.40 here. And then for our costing here, our budgeted, that was the $6 here, showing that, and that's on a per bundle basis here. And then for the actual amount here on our cost was $5.76. Just take those total amounts here that you've calculated here based on your chart here, and just lay them out here on your graph here. Okay, so now let's just go down and let's look at our numbers here, and let's just start with our break-even points just to understand where they fall into our chart here. So our break-even point, we calculated that to be 4,545 a quantity of 4,545 here for bundles sold here based on those actual sales. And we could just go through it here. We already calculated that, but just to refresh ourselves here, the break-even point is really our fixed cost divided by our contribution margin here per bundle. So for budgeted amount, fixed cost again was at 12,000 here. If we calculated our contribution margin, which we did, it was $3 here per bundle here. So dividing that 12,000 by $3 here, contribution margin per bundle, you're going to get 4,000 bundles that have to be sold here based on your budgeted amount. And then just looking at your actual amounts, we calculated 12,000 here divided by a contribution margin here of $2.64 gives you that quantity here of 45.45. So that's based on our actual sales here. Those are the bundles that we have to sell to break even. And then our quantities, we looked at those again. If it was for our actual amount here, we have to come up with 18,181 versus our budgeted amount was 16,000. So in both cases here, because we had that change in our sales mix here, where we were selling less of the item with the higher contribution margin per unit here versus that was B here, and we're selling less of B and more of A here, that's causing us this change here in our actual quantities and our actual versus our budgeted amount. So actual, we have to move up because of that change in our sales mix and those contributions per bundle here based on the budgeted and actual amounts. We're having to increase our break-even point from 4,000 to 4,500, and at the same time it increased our quantities that we're going to have to sell here for both A and B. Okay, so that's our break-even point here. And if you want to look at it in terms of just looking on our graph here and look at it in these curves, so we have in revenues here at that break-even point we'd have 38,000. So that would simply be that 4,545 times, and I've got everything rounded off, times in this case $8.40 here per bundle. That's going to round off to about 38,000. And then our cost, we have to subtract out our cost. That's $5.76 here per bundle times 4,545, and that's going to round off to about 26,000 here. Then we have to subtract that 12,000 for a fixed cost here. So that's our break-even point here. A zero here. We have generated zero income here or revenues here based on that break-even point here, 4,045. We'd go through the same thing here for the actual amount here. Okay, so then let's go up here and let's look at this costing here, that we can determine our contribution, determine what actual revenues we're going to earn based on those quantities here. And we're going to look at what we were going through here, those 10,000 bundles that are sold here. Everything is shown in thousands here. That's based on those 10,000 bundles. So we can calculate our income here. And maybe before we do that, just understand here this contribution margin here. That's simply the difference between our revenue line here and our costing line, and on a per bundle basis here. So you can see our contribution margin here based on our budgeted amounts, $9 versus less $9 here in revenue, $6 in cost. So that was a contribution, would be a contribution margin on a per unit basis of $3. And then what we were working with here for the actual amount, that was our revenues here at $8.40 per bundle here for our revenues, and less our costing of $5.76 is going to give us a contribution margin here of $2.64. So we can figure out our income here simply taking those 10,000 in our bundles that we're selling times our contribution margin here, $2.64, is going to give us $26,400 here. Subtract out our fixed cost here, 12,000, so our income is $14,400 here. Based on, again, this is actual sales here. Now, you can also look at it in these terms here, just looking at product A and product B, just to go through it. 10,000 here of the bundles that we're selling. Put in your sales ratio here for A was 3.6 times the contribution margin here is 60 cents per per unit of A here. That's going to give you $21,600 here. B, 10,000 times 0.4 here, that ratio, times $1.20 per unit here, contribution for B, gives us $4,800 here. Subtract out our fixed cost of $12,000, gives us an income here of $14,400. Same here, just above we just use the contribution margin. Below here we use that ratio here based on the contribution margin for each of the particular products, product A and product B. Contribution margin on a per unit basis for each of those. Okay, so that's our income here. Now if we went over here, you can see the difference here. We could have looked at it in terms of the actual amount here. We would have come up with it. We'll do that here. So just going back to our graph here, let's just look at what we calculated. So we could do it in terms of just looking at our graph here. That was for 10,000 units here. And let's look at it just in terms of what we actually had. 10,000 times what was that here? Our cost would be, first off, our revenues here, that would be $8.40 per bundle here, times 10,000 here. Got a little mixed up. Bring that across here, and that's going to give us a revenues here of $84,000. Simply 10,000 times $8.40 here per bundle. Revenues here of $84,000. Then taking our costing here, that would have been 10,000 here times $5.76, $57,600 for a cost. Subtract our fixed cost here of $12,000. That gives us a income here of $14,400. So that's based on just taking numbers, picking the numbers right off our graph here based on the contribution margin or our cost here per unit and our revenues per unit based on actual amounts that we calculated. Now if we went down here and just looked at what we actually have, and first off, this would be the red dashed lines here for our based on our actual amounts here. Now I got the blue dashed lines here for what we budgeted here. So based on our budgeted amounts, just going off our graph, we have 10,000 here in bundles. Our revenue that we budgeted is $9 per bundle here. That's going to give us 90,000 in revenues. Then our costing that was budgeted was $6 here per bundle times 10,000 bundles here. That would be 60,000 in costing. So subtract that from the 90,000, and then we have our fixed cost of 12,000 to cover. So we have an income here of 18,000 based on what we budgeted here. So the point is, this is how you would go about determining the difference between budgeted versus actual amounts here. And you have to determine your revenues per unit basis here, per unit when we talk about bundles here, your costing per unit or per bundle basis, determine your contribution margins, difference between revenues and a cost here, and then you can apply these here to determine your income here. And the point is, because we had, I guess the whole point of this exercise was not only to go and determine how you determine your income here, is to determine the fact that you had that change here in your sales mix here. And you started out with a greater, of course you had greater revenues here, $9 per unit versus actually what the actual amount was $8.40, budgeted $9, but you went down here $60 or 60 cents per unit because you had that change here in product B. We had here originally, we had 1 here, or a ratio of 3 to 1 here for A and B, but we increased here because the actual amounts, we had to go up to 3.6 units here in product A here, but it has a lower contribution margin per unit of 60 cents here, and that didn't cover what the amount that we went down here in product B, because we went down here from 1 to 0.4 units here in product B based on that sales ratio. So we were contributing less amount here than we wanted for product B versus than we had here for product A. Lesser than we want. A little bit, we had our contribution here in product A didn't cover the amount here that we needed here in product B here to make our contribution margin went down here per unit. That's all I'm saying, based on that sales mix or that sales ratio. So really what you want to do here, just sum everything up here, you want to, if you budget something here, you would like to be able to at least attain here whatever you have at your budgeted amounts. And just to sum things up here, if the opposite was true, if you were able to sell more here of product B with that larger contribution margin on a per unit basis, then the opposite would have been true here. You would have actually, your budgeted or your actual revenues on a per unit basis would have been greater here than $9 per unit here, and hopefully your costs would have been in line here. So you really have to look at your costs as well here. But the only point is here, the change here in the sales mix reduced the contribution margin per unit here. We would have had here $3 per unit here had based on our budgeted amounts here, and we actually come up with $2.64 here contribution margin on a per unit basis. So that really shifted our revenue and cost lines here. It shifted our revenue lines down. Of course, it shifted our cost lines down as well here, but the difference here was in that contribution margin per unit. We would have had a budgeted amount, if we went through the calculation, it would have been $3 per unit versus what we budgeted, or versus the actual amount here, $2.64. So if you get a shifting in your revenues and your cost line here, you would hope that you would have a case here where you could be selling more of that those products with that higher contribution margin per unit and lesser of the ones with the lower contribution margin per unit to bring up your total income here. Okay, so that'll pretty much summarize what we were discussing here, what we wanted to go over to make our comparisons here on those changes in our sales mix and how they affected our income here. But just remember, you have to come up with, when you're dealing with these bundled products or these group products, you're going to have to come up with the sales ratios for each of those products based on your total quantities or total sales that you're looking at, and then based on those sales ratios, then you can plug those numbers into either your operating income equations, or as we laid it out here on our charts here, which is essentially the operating income equation to determine our revenues and on a total revenues on a in this case a per bundle basis here, or per group basis, total cost here, and then the difference gives us a total contribution margin on a per bundle basis, or total on a per group basis. Okay, so that'll pretty much summarize our subject.